When we zoom in on today's global bond markets, one striking reality emerges. The United States is trapped in a debt spiral where borrowing costs are significantly higher than those of its rivals. At the core of sovereign finance sits the 10-year government bond, the benchmark that tells us how much a nation must pay to access global capital. Right now, the U.S. pays an average of 4.28% interest per year on its 10-year debt. China, by contrast, pays just 1.7% for the same duration. Even more telling, China's rates are falling across the curve, from 2-year to 30-year maturities, while America's remains stubbornly elevated. Put simply, Beijing can borrow at less than half the cost Washington must pay. That divergence is not just unusual. It is a flashing red light that marks a profound shift in the balance of economic power. On the surface, China's economy is facing its own headwinds, with domestic deflation and slowing consumer demand. But paradoxically, those very pressures have created conditions that strengthen Beijing's global position. Prices for both consumers and producers are falling, driven by relentless improvements in manufacturing productivity and supply chain efficiency. At the same time, exports remain robust, far exceeding the expectations of many Western analysts. The result is a peculiar but powerful combination: strong external demand, muted internal inflation, and borrowing costs at historic lows. This gives China's government an extraordinary strategic advantage: cheap and abundant capital. And cheap capital is not just an accounting detail. It is the oxygen of global strategy. Consider the Belt and Road Initiative. Western critics often describe it as debt trap diplomacy. Yet even those critics have been forced to acknowledge a stunning fact. The weighted average interest rate on Chinese loans to developing nations, particularly in Africa and South America, is about 4.2%. Let that sink in. Countries in the global south can now borrow US dollars from Chinese banks at lower rates than the United States government itself can borrow US dollars. By every traditional financial logic, this should be impossible. But it is happening, and it signals a structural advantage for Beijing and a systemic crisis for Washington. This paradox is not an academic issue. It is an immediate challenge for America's policymakers. Treasury Secretary Scott Bessent took office, knowing full well the danger. Long-term interest rates are simply too high. Issuing 10-year or 30-year bonds at these levels would lock the U.S. into decades of crushing costs. The Treasury's only option has been to pivot toward the short end of the yield curve, leaning heavily on Treasury bills that must be rolled over multiple times a year. This is not a strategy born of strength, but of desperation. Even President Trump has echoed the same point. Until the Federal Reserve slashes rates, the U.S. has no sustainable path to finance itself. But that strategy is fraught with danger. The first danger is scale. The U.S. must raise an estimated $2 trillion annually just to cover its deficit. Layered on top are inflationary pressures driven by new tariffs, which push up producer prices. Investors, sensing this, demand ever higher yields no matter what the Fed's short-term rate policy may be. The second danger lies in the myth of the Federal Reserve's power. A rate cut by the Fed only lowers the overnight rate at which banks lend to one another. It does not directly move the 10-year Treasury yield or mortgage rates. Yes, the two are correlated, but recent history tells the story clearly. The Fed cut rates 3 separate times, yet mortgage rates barely moved, staying elevated because long-term bond yields refused to fall. That disconnect reveals a harsher truth. The Fed's ability to shape borrowing costs for families, businesses, and the government is far weaker than the political class would like to admit. The refinancing burden, meanwhile, is staggering. Over the next year alone, $9.2 trillion of existing debt, much of it issued when rates were near zero, must be rolled over at today's much higher levels. On top of that, Washington needs an additional $1.9 trillion in new borrowing to finance its deficit. That's over $10 trillion in gross borrowing for a single year. Put differently, it is now more expensive for America to service its existing debt and fund its budget than it was to fight World War II and rebuild Europe. This is fiscal gravity at its most unforgiving. Issuing new, expensive debt just to refinance old debt is not a strategy. It is a death spiral. And the global capital market is straining under the weight. There may simply not be enough appetite or liquidity in the system to absorb Washington's needs without driving costs even higher. Foreign investors have already begun to back away. Chinese regulators are recycling their vast trade surpluses not into US Treasuries, but into gold, domestic banks, and overseas development projects. For the first time in over 16 years, Beijing's holdings of treasuries are at their lowest point, and still declining. Even more alarming, China is no longer a passive non-buyer. It is an active seller, trimming its US debt exposure month after month. That leaves Washington dangerously exposed at its bond auctions. The results are already visible. In the first week of August, 3 consecutive auctions sent shockwaves through the markets. On August 6th, a 3-year bond sale saw the weakest foreign demand since 2023, forcing yields higher mid-auction, a tailing event dreaded by the Treasury. On August 7th, a $42 billion sale of 10-year paper met the same fate, another ugly auction with alarmingly weak foreign participation. On August 8th, the 30-year auction may have been worst of all. Foreign demand was the second lowest in 5 years, driving yields higher across the curve. These were not isolated incidents. They were flashing warning signs. Foreigners are not showing up, and the cost of funding U.S. debt is surging as a result. This creates a vicious cycle. When the Fed does eventually cut rates, markets are already signaling that inflation expectations will rise, pushing long-term borrowing costs higher anyway. The yield curve will steepen dramatically. Overnight rates may drop, giving the Treasury some temporary breathing room for short-term bills, but for households and businesses, the pain will intensify. Mortgage rates will remain elevated. Corporate borrowing costs will rise. And the government itself, dependent on rolling over trillions, will face ever-mounting pressure. Pause and consider the global symbolism. An African government today can borrow US dollars from Beijing to build a railway at a cheaper rate than the US government can borrow US dollars to fund its budget. Meanwhile, an American family pays double that rate just to finance a mortgage. If that doesn't signal a turning point in global finance, what does? This is where geopolitics and economics converge. China and its BRICS partners have spent years building an alternative to the dollar-dominated financial order. They are now reaping the benefits. Their governments, corporations, and households have access to borrowing costs that are half of what Americans face. And access to cheap capital is not just a financial advantage, it is the foundation of economic growth itself. Consumer spending, household formation, corporate innovation, infrastructure building, all of it depends on affordable credit. And here is the uncomfortable truth. America, once the unrivaled engine of global finance, no longer has that advantage. Instead, it finds itself trapped, locked into a cycle of ever higher borrowing costs, collapsing foreign demand for its debt, and the steady erosion of its fiscal credibility. Unless Washington can reverse this trajectory, the consequences will not be temporary. They will shape the balance of power for decades. Think back to the title of this video, the U.S. debt trap. That phrase is no exaggeration. A trap is something you walk into without realizing the danger, and once inside, every move only makes escape harder. America's reliance on short-term debt, its staggering refinancing burden, and its shrinking foreign support are the bars of that trap. And while Beijing builds influence with low-cost capital, Washington is struggling just to keep the lights on. The question now is not whether this debt trap exists. It clearly does, but whether America can find a way out before it is too late. Will Washington tighten its fiscal belt, rethink its spending priorities, and rebuild confidence in its currency and bonds? Or will it double down, borrowing more at higher costs, until the trap snaps shut completely? That is where I want to hear from you. Do you think the United States can escape this debt trap, or is it already too late? And if Beijing and the BRICS really do gain permanent access to cheaper capital, what does that mean for America's role as the global superpower? Drop your thoughts in the comments. Because the debate over America's debt trap isn't just about economics, it's about the future of global power itself.